Obviously the goal here is to talk about trading, kind of walk through everyone what I do. Before I do that, though, I do want to be responsible and kind of talk about the basics and the fundamentals because I know that some people here are brand new to the stock market, brand new to the world of investing. So let me be clear that even me, someone who's trading the market all the time, I am always investing. I have an investment account. You want to build your nest egg, okay? Passive, incremental. You know what? Here, 1 second. I'm gonna fix this. I want to fix this so that people can see. Okay, passive incremental investing works. All right. Nope, don't bother timing the market in your investment account. Okay. Always take some money, incrementally buy the market. Whether that's every week, every month, every 6 months, every year. Doesn't really matter. Just make sure you're constantly building up some sort of nest egg, especially at times when you're not doing well in the market. When you can look at that investment nest egg, you can kind of feel secure, right? You want that. I think Acorns is probably one of the best things to do for newbies who are maybe scared to start a brokerage account. This thing's going to grow so much faster than you think it will. Right here, this image right here is of an Acorns account from one of our traders where he's just been every time he buys something, it rounds up $1 that goes in the Acorns account, right? And you can pick where that goes into the market. You can also set it up to have reoccurring investments, $5 a day or whatever, to put money in the market. It grows so much faster than you will. You'll get a good idea of how investing works, how that compounds so fast. All right. I think Cash App is also undervalued. Okay. It's great for just buying a few stocks, buying some crypto, some Bitcoin. If you're wanting to get in crypto, I think Coinbase, stick to the biggest player, right? Safest. A lot of these cryptos, they're very sketchy. You should be worried about them, whether they're even legal or not. Coinbase is great. If you're new to crypto, just stick to the big ones. Bitcoin, Ethereum, Solana, incremental buying there, stick to it. If you're wanting to get trading, you're wanting to know what broker to use, I think Weeble's great. They're completely free, especially with options trading. A lot of the traders in the Discord use Tastyworks. I like them as well. They do have fees. It's 50 cents per contract that you purchase. Personally, I use Thinkorswim platform. A lot of people think it looks really old and antique. This is what I've been using since I started trading. This is where I previously worked. I'm the most comfortable with this. They also allow you to have a debit card linked to your account. I think that is fantastic. And remember, a lot of people forget that if you have money in a brokerage, you can also collect interest if you just sit on the cash. Okay. This can be used like a savings account. Some of them will even give you more than a savings account will on interest. So don't forget that as well. All right. So always be investing. Don't forget that. All right. So let's cover also the basic indices, the ETFs, the things you hear about on CNBC, right? You cannot buy these indices, but you can buy the ETFs that track them. Okay. Most popular ones you're going to hear about on CNBC. They're going to talk about it every single day. Where's the SPY index at? What's it doing? All right. This is top 500 companies in the US. Then you have the NASDAQ top 100. Okay. These are mostly tech stocks. That's what ends up being the biggest companies nowadays. You have your Dow. I call it the Boomer Index. This is market cap weighted. It barely moves. It's very boring, but these are long-term profitable dividend yielding companies. What does a dividend mean? It means that they're paying you for owning the stock on a quarterly basis. Okay. Then you have the Russell. This is your speculation. This is your small cap companies. There's over 2,000 companies within this index. All right. And they could blow up. They could not blow up. This is where a lot of people like to sit at their stock pickers. They like to pick out the companies that they think will be the next Amazon. But there's also an ETF for every sector you can think of. Okay. So lots of people, when they ask you like, oh, biotechnology is going to blow up, but I don't know what to pick. Everyone loves semiconductor companies because of AI. What do I buy? Look, you can buy XBI for biotechnology. You could buy SMH when it comes to semiconductors. What you're doing is you're trading some of that risk for a lesser reward, but it also means you can spend less time and probably make some good money. Okay. If you just bought the SMH for semiconductors and excitement for AI, you made some good money. Not as much as people who straight up bought NVIDIA or bought SMCI, but you got good returns. You didn't have to do the risk or the research of picking stock names. Okay. All right. So now let's talk about diversification real quick when it comes to investments. We'll get into trading here in just a moment. So I think lots of people get diversification wrong. They think they got to have like 50 stocks on their watch list. Okay. Any more than a dozen names in different sectors and you're diversified. Remember, you can't diversify out of things like systemic risk. If a comet hits the planet, no one's going to care about your gold stocks. Okay. Yeah, right. They're not even gonna care if you have gold bars. You're probably gonna want guns and ammo. So and food. But this is, I think, something that people focus on way too much. Consolidation is how you generate massive amounts of wealth. Think about Bill Ackman, one of the greatest investors of all time. He's never in his career owned more than 8 stocks ever. And he's a legend. Okay. So keep that in mind for diversification. You shouldn't have like 50 different names when it comes to your portfolio and your construction, especially if you're just buying ETFs. All right. So at NBT, what do? Do we day trade? We do day trade. Okay. Remember, day trading is technically opening and closing a trade in the same day. All right. It can be done with stocks, options, futures, crypto. There's many different ways to day trade. But day trading is also the highest risk form of trading. And even if everything's perfect, you think you have the perfect setup, the technicals work, there's a piece of news that came in your favor, anything can set that off. Jerome Powell could come out, say he wants to raise interest rates. Yellen or Biden can trip and fall, hit his head, and then no one knows what's going to happen, and the market just crashes. All right. These are things you cannot predict. And so when it comes to day trading, it is very important that you control how much you put in the trade and you keep that in mind. This is the highest risk thing you can do. So that's why it's only a small part of what we do. Most of our trades take multiple days, sometimes multiple months, sometimes even multiple years. The more time you allow in a trade, the more time it allows for fundamentals or technicals to play out, and it also lowers your risk as well. And so if you're wanting to get in trading and you got a small account, you also need to be aware of pattern day trade restrictions. Okay. You need to have at least 25 in your account for a margin account to be able to open and close more than 3 trades a week. All right. But you can avoid this if you have a cash account. You could just message your broker, or when you're setting it up, tell them that you want to do a cash account. The trade-off is that you have to give a day for these funds to settle. So you will be limited to how much trading you can do on any particular day. Some days you won't trade at all. Some days you'll trade 5 times. You will be limited if you're in a cash account and you have a smaller account. And remember, I like margin in my investment account, especially if the market is very bullish and I think it's a safe environment. I have margin for instant clearance on my trades in my trading account, but I don't utilize it. I don't actually use a margin. I just want the instant clearance. All right. Does that make sense? Everyone, is there a way I can see chat while I'm talking? I don't know if there is. Okay, we're gonna move on. I hope it makes sense. We'll do questions at the end. So if there's any more questions, just let me know. All right. So what are options? All right. An option call is like having a special coupon to buy something at a certain price, even if the price goes up later. And a put option is like having a special coupon to sell something at a certain price, even if the price goes down later. Okay. So with a call, your anticipation is that the stock continues to rise. With a put, your anticipation is the stock goes down. But remember, like coupons, I feel like someone's going to mute you. Remember, like coupons, options can expire. They can become worthless. There's a certain duration. There's a certain time frame that you're looking for when you purchase an option. And don't forget, options are not just for trading. Lots of people think that this is like only for high risk trading. Options can be awesome for investing as well. Okay, let's say you're in your investment account, you think a stock could do well, you think it has good fundamentals, but you're not so sure about what position you get. You can buy an option contract that allows you to buy a large position of stock for a fraction of that and wait to see if your fundamentals play out. If they play out, you can then execute the contract and take those shares and run with them. It is a great way to control your risk in that long-term account and be more flexible than you would with just straight up buying shares. All right. So when you're getting the options, if you're new to this, make sure you learn the major Greeks. For newbies, by the way, there's like a dozen Greeks. But for newbies, when you're just getting started, make sure you're at least aware of your delta, which is the change in price of the option for the underlying move in the stock. And then theta, which is your time decay. And then vega, which is your volatility. We're not going to dive super deep into these. I just want to kind of break down my strategy and everything. Remember, there's a lot more. We'll do a Q&A if you have more questions. We also have some educational stuff in the Discord. We'll go to the next slide. So I am a buy side options trader. It means I'm mostly buying calls and puts. My goal when I'm on the buy side is to beat the market. I had to be smarter than the market. I had to think that the market has mispriced something. I see something the market doesn't. Okay. So when I'm doing day trades and I'm in and out same day, like we talked about, right? I'm purely using technical analysis or I'm looking at major levels. Has this stock hit this same price point multiple times? And once it achieves it, makes a big move. That's what I mean by a major level. Okay. For longer dated trades, your fundamentals should align with the position. Okay. So let's say there's a stock I like and there's something bullish happening with them, then I could take that call position. But let's say there's a stock I like, something terrible happens, it dips down. Do I want to short it? No, I want to wait for that short to happen and then become bullish. Same thing on the opposite end. If I'm bearish on a company, okay? Do not trade against your underlying fundamentals. Remember, when you're also setting up these trades, liking or disliking a stock is not a reason to set up an option position. Remember, this is the most aggressive way you can express your sentiment on a stock, and you're set locked into a certain time frame. You can't just generally be like, oh, I kind of like this. You want an actual catalyst for this. Earnings calls are not catalysts. There's hundreds and hundreds and hundreds of analysts that go over these companies, track every penny, and they're usually pretty good at doing their job, especially when you're talking about options. So even if it goes in your direction, you might not make any money because it's already priced into the option contract. So what we're looking at when we're looking for catalysts, when we're planning out our trades, we're looking for something like an analyst does an upgrade or downgrade in the future on the stock. You could track when they've done these upgrades and downgrades. Oh, they haven't covered the stock in over a year. It's getting really popular. I imagine they're about to put one out. You can look at upcoming seminars. If there's a big tech company and they're going to an upcoming technology sector and they haven't talked about this new tech that we know is in the works, that could bring excitement. Big rumors, buy the rumors, sell the news. This also works as well. It's a very classic way to trade a stock. Addition to major index, we actually have an example of this I'm going to talk about. It's when companies get added to the S&P or when they get added to the Russell or those major indexes we spoke about, that causes lots of different institutions and lots of interest to just automatically buy those shares, usually causes big inflows into those stocks. Short squeezes, drug approvals, regulation, or even just sector trends like AI sector trend. AI is extremely popular. All these companies are set up for huge rallies. And I think this will continue till the end of the year. That can even just work. You know, you're saying NVIDIA, it's just the hype. It's just the name of the day. It's everyone's beloved stock. That can also be a reason to go ahead and pick it up. Okay. Now, remember, things like short squeezes are not going to be the same as these other types of catalysts because these are more mechanical. Okay. Short interest. If you're looking for something like a short squeeze, this is your GME. This is your AMC, right? Whenever 2020, everyone was freaking out about these stocks. Okay. You want to see that short interest over 40%. Because then when people start buying that stock, it causes the people who are short on the stock to panic and have to buy back the shares they're shorting, which causes those parabolic moves. Lots of people like to hunt for these all day, every day, but they often are a little too greedy, not looking for that key 40% amount. Okay, that's a catalyst. I just wanted to point that out. Always be aware of the volatility built into the stock. This is going to be your Vega. It's going to be listed as your IV. I'll show you in a moment what that looks like when you set it up. But the reason this matters is, remember when I was talking about those earnings calls where it's probably already priced into the stock, so it's not a real catalyst to look for? It's because of that volatility built into the stock. You can look at things like your historical IV. You can just simply type into Google historical implied volatility for Apple, and you can find a chart with that and see where it sits. Is it really high where it's at right now? It probably means that you're overpaying for the contract and it might not go in your favor. Remember, you can't just have a right idea. You have to have the right opportunity and the right price for that opportunity, okay? It's really important. It'll do wonders for your win rate. So let's talk about an example right now in this market that I like, okay? SMCI. I mentioned them earlier. It's just one of those AI names. As you can see, the stock has gone absolutely parabolic. It is actually the most valued company in the Russell index. Remember, we talked about those were the small speculative companies, right? Well, it's at $831. It's not as speculative. They've done a good job of proving themselves. The fundamentals here are really solid. So my catalyst here is that this company will likely do a stock split and then likely get added to the S&P 500 in the future. So a stock split is when you receive 4 shares for every share you own. That is another very bullish catalyst. If you do historical analysis on that, you have a very high win rate. I think it's like over 70% win rate for that. And the being added to the S&P 500 also causes lots of inflows of buyers as well. Now, I bought shares on this and not options because if we look at our current historical volatility percentile, it's at 100%. The option contracts on this stock are ridiculously expensive. And so I don't think it's a really opportune moment. I think I carry a bunch more risk. So I don't want to express my bullish position by buying those options right now. I want to wait for a better opportunity. And so I loaded up some stock. When I loaded up the stock, I set out my key levels. Remember, key levels, where are the points where the stock has big turns or pivots. Look for multiple points of contact as well. Very simple. Very, very, very simple when you're just playing key price points for a stock. And right now we're in great profits on this. So, by the way, our fundamental target is also 1700. Shout out to Monty, who some of you might have heard at the beginning of the call talking about his Peach Pit Substack. He's a researcher, part of the inner circle members of the Discord. And he did some great research on that over on his Substack. You could DM me if you want to link at that. So then let's talk about something, an actual options trade right now. This is a trade that I have right now that I'm looking for. I did my technical analysis to play out my levels. This time I used Elliott wave analysis and Fibonacci levels. We'll talk about more technical analysis stuff in here in just a moment, a few slides. But I set my levels for what I'm looking for. I'm looking for a pullback or retracement on the SPY index. Okay, my catalysts are FOMC. It's a huge Fed meeting where they're going to decide interest rates. I expect that to be rough. We also have banking events. I'm not going to get in super in depth in what's going on with the banks. You might know, you might not know, but that would be like a whole other hour to explain what's going on there. And then we also have seasonal weakness. If you do historical analysis, March is usually a very rough month for the market. So given that this is a perfect 5-wave pattern for Elliott wave analysis, I'm looking for these key levels on the pullback. I also look at my option chain. I decide to get a 34 delta. I make $34 for every dollar this down the stock goes. Okay. So I like that. It's a pretty aggressive play. Okay. And then I also look at my historical volatility percentile. It's about middle of the ground. It could be better, but I think it's still pretty low. The implied volatility built in my contract's about 14%. That's not half bad, right? So I saw it as a good opportunity to go ahead and buy those contracts. As this goes down, volatility will also build in the contracts. So I'll probably make more than $34 for every dollar point move down on this stock. So that's an example of a good opportunity and a good price. So for the sell side of options, we actually have a specialist who mostly trades sell side options. Abe, you want to go ahead and step in and cover your strategies that you use for sell side?
Yeah, I'm sorry, I wasn't here for sound check and all that kind of stuff. Can everybody hear me?
You sound great.
Why, thank you. You sound not so bad yourself. All right. Hey, everybody. Thank you for being here. So Josh is kind of a little bit of a different style of trader as myself. As he just kind of displayed to you, he does the buying side of the options. Occasionally, I can get him over to dabble and play in my arena, but for the most part, he's mostly buying options with the intent to follow a trend or a catalyst and profit off of that. But that's not the only way that you can profit with options. And I will caveat this with selling options is traditionally kind of thought of as a little bit more of a risky way to trade. Traditional finance doesn't usually encourage people to be selling, especially naked options. What I mean by naked is basically when you buy an option and you just simply straight go long something, you're basically naked long it, or when you sell an option by itself, you're naked short it, meaning you have the naked part of it comes into play where you have unlimited risk when you're selling an option. Um, so some of the differences that he's already covered some of the characteristics of buying options. It's a very it's a very technical thing. Usually comes along with technical analysis. Whereas when I'm when I'm selling an option, I'm kind of doing the opposite that he's doing. I'm just simply taking the house's uh the house's bet. I'm betting that the market is not going to beat me in the long run. If you look at the comments here, it says you're betting the market's not going to get to the target. So I'm being paid up front in the hopes that the market will not reach me. It plays into the fact that most options expire worthless. If you look at the actual statistics behind options, the vast majority of options contracts actually are worth completely nothing. They're completely worthless upon expiration. So the idea of selling options is kind of built around that. How do I profit off of the fact that I know that a lot of options expire out of the money? Well, you try to find and build your strategy around that and profit off of that. So it's not necessarily technical. The next bullet point here, it's not necessarily a technical strategy. It's basically a statistical probabilities game. A good way to think of it is kind of like at a casino. The casino is constantly putting the edges and the statistical probability in their favor, even though it's by a little bit. They want you to keep coming and playing. They want you to win every once in a while. But at the end of the day, the casino is in business to make money. So they're taking trades or they're taking bets that they have a little bit of a higher probability of winning and trusting in the high frequency of occurrences, meaning they want you to come and they want you to play a lot because they want the probabilities to play out in their favor. And this is the same type of strategy. It's not catalyst based in the same sense that you're looking for a catalyst to enter a trade. But catalysts do come into play in that when a catalyst happens, usually that triggers a move in a stock. And once a stock does have a large move, sometimes there can be opportunity on the sell side as well, because that'll get into more of implied volatility. So I'll leave that for a little bit later on, but it's not necessarily catalyst based. Like I can sell premium anytime where I think I see opportunity and just let time pass. And ideally, if the market doesn't beat me, I make money. It uses where did I lost my place here. It's trades based on implied volatility and implied volatility percentile. So I guess I should probably kind of define what implied volatility is and implied volatility percentile is, because they're they're two terms that sometimes get used interchangeably, but they're not the same thing. So implied volatility is is basically, if you can go to the next slide, Josh, real quick, we'll come back to this one. The next slide we have, so implied volatility is basically an expected move in the future. It's how much the stock is expected to move. So if you look at these two option chains, it's the second and the fourth picture. If you look at those two options chains, they're for stocks that are relatively similarly priced, but their implied volatilities are wildly different. You can actually see their implied volatility on pictures 1 and 3. Josh, well, no, on pictures 1 and 3, yeah, that shows IV percentile, but IV is the one right before that. So the first one has an IV of 28%, and the second one over here on Mara has an IV of 158%. They're wildly different. And if you look at the actual options chains, you will see that reflected in the premium of those options. So even though Mara is a smaller stock in price, it's trading at $31, and GM or General Motors is trading at 40. Even though that's the case, because of the implied volatility, the price difference between these two chains is drastically different. Okay, so basically that's what implied volatility is. And it's derived. Implied volatility is a derivative, meaning it comes from those prices that you're looking at right there in front of you. Those prices, what people are willing to buy and sell those contracts, they're being offered and offered for other people to buy, and people are buying the bids and the ask. Those actually are what determines the implied volatility of that stock. So it only makes sense that the one that's way more expensive to buy those options, you're going to see that reflecting in 158% volatility, and the ones that are cheaper is reflecting in a 28% volatility. If I make no sense, I'm sorry. Just this is kind of getting into a little bit of the nitty gritty. Now let's go back to the other slide real quick. So the next part about this is implied volatility, percentile, and rank. Now, this is just a metric that most brokerage platforms will have available for you to see, and it gives you a little bit of context about implied volatility in relation to itself over the last year. So where is implied volatility right now compared to where it's been for the trailing 52 months? Is it higher than it has been, or is it lower than it has been over the last year? So if we go back to the image, we can see that this particular stock GM, the first one, has an IV percentile. That's a historical. It's the second one, Josh. Yeah, IV percentile is 30%. So that means that 70% of the year that IV has been higher in this particular stock for the last 12 months. So when let's first go look at Mara before I get into this. This one, it's such tiny text. I think it says 66%. That means that this particular stock is a little bit has an elevated percentile, meaning that it's in the higher echelon of its ranking of IV, meaning there has been more movement in the stock and it's resulted in higher prices in options in relation to where they historically have been. It's not at its highest, but it's also pretty good and pretty high for someone like myself that's going to try to sell this. And you'll notice, so if we look at GM stock, you'll notice that the $36 strike for puts, they're only going for 23 cents and 24 cents. So that's the bid and ask. And then on the other side, on the calls up at $46, you'll notice they're only going for about the same, 29 and 30 cents. So whereas a stock that like Mara has a much higher, you can see that you can take your risk so much further away from the stock price and still be compensated a decent amount for taking on that risk. All right. So now let's get back to the actual the slide here. There we go. I hope that was making some sense to everybody. And the next part, we want the stocks with increased risk. We want these stocks with these premiums are kind of jacked up. They're on steroids, they're on crack, and there's lots of juice in them. And you saw that with Mara, where you could go far away from the stock and there wasn't enough room to show you the actual full option chain in that picture. But you can get very, very far away from the actual stock price where the stock is currently trading and still collect. You can still sell premium and bet that the market's not going to reach that. So like in a stock like Mara, even though it's trading at $30, I can go out in the April expiration and I can sell, the $15 strike and still walk away with a 45 cents in premium, or the equivalent of $45. And the stock price literally has to be cut in half before I lose on this trade. And the same thing to the upside. You can go very far away to the upside. So that's what juicy premium allows you to do as a premium seller, is get far away, allow time to work in your favor, and take the bet that the market's not going to beat what the current quoted prices for the options are, that it's not going to reach those places. Requires a margin account. So just like Josh has a margin account, but he doesn't use margin, this requires a margin account because of the fact that if you're selling a put or you're selling a call, theoretically, there's no limit how far up a stock can go, and the stock can also go all the way to zero. So because there's no definition of your risk, they're going to require you to have a margin account where your actual amount of money they're going to keep when you put these trades on is going to fluctuate. So it could change from day to day depending on how the stock moves. larger amount of capital. So when you're selling this, traditionally you need a larger amount of capital in your account overall in order to be able to sell options. And most brokerage platforms out there are not going to let you fresh off the street to walk in, open up an account without any trading experience and with limited capital and give you even permission to do these types of strategies because they're a little bit more thought of as an advanced and a more risky type of strategy. I find it ironic that they're thought of as more risky because I view them as less risky because I can put on a trade that I have an 80% probability of being successful on. But that's just a matter of how your own risk comfortability and your view on risk works. But there are some brokers out there that allow you to do that, but it's not a great idea for you to just jump in and start doing this type of strategy without actually doing a lot of research and getting into it gradually. Traditional finance, like again, traditional finance considers this to be a more, we already kind of covered that. So next slide. I had another slide after the image, didn't I, Josh?
I don't believe you did. I think that was it.
I didn't.
You wanted to cover something else? Anything else you want to
Not
cover?
necessarily. No, I was gonna dig a little bit deeper into it, but
We'll do
I think
questions
that's
at the end.
a kind of, yeah, I think that's good.
Okay, cool. We'll do some questions at the end if anyone has any more questions. So now what I want to talk about is the technical analysis, what I use when I'm trading. I get asked this a lot. Remember, for most of you, over your period of your journey of trading, you will likely develop something that works for you. I'm not saying this is the only way to make money. There's lots of different techniques that people use. I'm simply telling you that this is what works for me. Okay. I use TradingView for all of my charting that I do when I'm doing my technical analysis. I am an affiliate, by the way. So if you want a discount, you can click the link on my socials. I use Elliott Wave analysis for my long-term technicals with fibs. We have a free course on this in the Discord. That's free to check out and learn about those. If you want to DM me after the Zoom call, I can send you a PDF book as well for Elliott Wave analysis. But we're not going to dive too deep into that one because that would be a whole, I mean, that would be like a 6 hour presentation to cover it as in depth as it goes. But if you want to read the book, great tool. Elliott Wave analysis has been really, really helpful for me. I also use on longer time frames TTM squeeze and RSI as well. I think lots of people know about RSI, relative strength index. And then for short-term trading, I actually use what's called Rifster EMA clouds. Okay, this is a script that you can use on TradingView. It's free to use. I got to type in as Ripster. You'll see it. It'll be the first one that comes up. Ripster EMA clouds. These are a collection of estimated moving averages for a stock. These are key levels that are really helpful for short-term trading, showing you where, if the stock's still currently in a bullish movement pattern or if it's in a bearish movement pattern on shorter time frames. No, I also forgot to add for Elliott Wave analysis, I'm also using the Fibonacci tools that are available on TradingView. Again, these are going to take some time for you to learn how to use. Fibonacci's typically are looking for like the high, the low, and then they're looking for the levels. Some close to what we see here, where I'm looking for the retracement based on the Fibonacci's here for the SPY index. But the one thing I kind of want to highlight is TTM squeeze across Twitter and stuff. I see lots of people who say that this isn't a useful indicator, or people who are talking about this indicator that I think are using it completely wrong. Okay. This is technically a volatility and momentum indicator. And the key here, what you're looking for is confirmation with multiple time frames that the more that align across multiple time frames, the stronger confirmation you have on the trade. Okay. So actually the example is today's trade that we took. We made some money shorting the SPY index. We saw this head and shoulders pattern that was forming on the 5-minute chart. The TTM squeeze started was breaking down on the 5-minute. It broke down to the downside on the 15-minute. We saw the breakdown confirmation of the 30-minute and the 1 hour. Tomorrow, these also turn over to the downside as well. It'll be even further confirmation that the index will likely sell off. Those multiple confirmations across multiple time frames, the stronger they are, the more they align, the bigger move you will get. Okay. So you use this in conjunction with something like your key levels, or use this in conjunction with something like your fibs. You can then set your exit targets. Okay. So That's going to be really important. And if we're looking for something like what a stop would be when these start to reverse. If you're looking at these on multiple time frames, and let's say the 5 minute is bearish, but the 15 minute is firing to the upside, and then the 30 minutes to the downside, the 1 hour to the upside, it means that your stock is likely in a period of consolidation. It will likely trade sideways for a bit longer. Wait for the actual confirmation there. It'll be really useful for short-term moves and short-term trades if you can get that alignment. Okay. And this is even helpful for things like futures. If you can get that alignment, you'll get those big moves you want. Extremely helpful. Yeah. I think I about covered that. We got questions too. Okay. Risk management, probably the question I get asked the most by new traders. So important. All right. Your goal as a trader is to not get rich off 1 or 2 trades. You want to get rich off 1,000 trades. Always be protecting your capital. Okay. If you blow up half your account in just one trade, you're not going to be able to take the same amount of risk with the next trade, and it becomes harder and harder and harder as you spiral downwards. Okay. You want to be able to make the same trade 1,000 times in your account. Okay. You want to define the risk you put into a trade with the amount you want to define the risk of your trade with the amount you put into the trade. Okay. If I only put 1% in a trade, I only lose 1% of my account. That's good. All right. That's because you're going to lose trades. And day trades, the highest risk form of trading, where I'm opening a contract and I plan to close it in the same day, play for 0. Okay. Play with the anticipation that this will not make money, and then you won't blow yourself up doing something stupid. You're trying to play probabilities over a long time frame. What you're doing in the execution is short term, but your game plan for doing this in the long term should be about the probabilities. It should be how much you win over 100 trades, not whether or not you win in the next trade you're about to make. Okay. So make sure to it also helps with you getting your mentality right. If you're thinking about all the profits you could possibly make, you'll probably make the position too large. Okay. And a good way to know personally, because this is personal at the end of the day. Okay. These are just solid guidelines. A good way to know if you put too much into a trade is how you feel. You're going to have to self-reflect. If the position starts to go against you and you start feeling panicky, you put too much money into the trade. Okay. With time and experience, you're going to be better and better at managing these emotions. If you have to just trade one contract, or else you're getting really emotional, you're getting really worried, you're getting panicky about it, then so be it. Okay. If you're small, find a smaller stock to start out with. Okay. Time and experience will make this easier to manage your emotions, but not managing those emotions is the fastest way to blow up your account. Okay. People always ask me about taking profits on trades. Always be taking profits on trades. Okay. When I set up a trade in the Discord for members, I have a stop and I have 3 targets I'm usually looking for. At each target, I am taking profits. And sometimes, because remember, options can move, like Noob Trader said, when it comes to the applied volatility, they can move pretty dramatically when the stock moves. So let's say we haven't hit my target, but my contract's already up 20%. I'm in a short-term day trade. I'm probably going to start taking some profits, start taking some contracts back. Okay. Always be locking in profits. Always be protecting that capital. Okay. And when I hit my levels, I'm always taking profits. If I hit my level, but it's only up 10%, I'm following my rules no matter what. Okay. And this is a key one. Never set automated stop loss for options. This one's hard for a lot of people because they feel like they're doing the right thing. Oh, I might get distracted. I'm not going to see what's going to happen on the market. I'll just set this to automatically sell if it hits such and such level. This is a very bad mistake to make, especially since it will destroy your mental when the market inevitably barely touches that level and then immediately shoots up. Okay. All right. These orders get literally sent through. They appear on a screen, and the market maker can go, oh, I could just buy that for cheap and just move the market, snag them up. But also, you want true confirmation of these stops. I have stops set in my head. I write them down, of course, but I want a candle to go through my stop and then another candle to confirm it before I know okay, that's not playing out. The amount of times the market will hit these key levels and the reverse is really high. So you need to understand that you need confirmation of a break to get out of the trade. Okay. They is automating it. It's just going to hurt you in the long term. You're going to lose a lot of trades that would have come back to you if you have a hard set stop loss. When you get really experienced, you'll also know what times you can go ahead and say, no, I'm going to hold this one. And if you're using appropriate risk management, there will be times where that's okay to do as well. Okay. Great example of that is yesterday I was short Apple and Google. Apple announced that they're cutting their EV program and moving a lot of those workers over to AI. Market loves that. And then it started to rally intraday. We went through my stop. I let everyone know that I was going to hold those contracts until today. Today, those contracts that were down 40% yesterday came back today for a nice 20% gain because I thought that the overall environment was still very bearish. I thought my technicals hadn't truly broken, even though I went through my stop. But you need to have a lot of experience before you do that. When you're starting out, follow your plan, no matter what. Okay. Get 5 years under your belt before you start breaking your rules. Okay. And if you're having a bad day with many losers, walk away, take a break. Okay. When I said those emotions kill counts fast, they kill them really fast. Okay. So if you start losing, nothing seems to be working. The market doesn't, you start feeling like the market's just rigged against you today. And it's just, you just can't figure it out. Just take a break. Okay. You don't have to trade every single day. And that also goes down with let trades come to you. Do not force them. Okay. Once you've been paying attention to the market, you got a few years under your belt. Some people, I know some prodigies, it only takes a few months before they start recognizing patterns. You'll know when the stars align. You'll know when you have something and you should take max risks. And it seems like this is the trade that will make me a bunch of money. Everything looks right here. Okay. You'll know that when you see it. The worst thing you want to do is wake up every morning and be like, okay, I need to make money today. I got to hit a certain target of income. This is terrible mindset. This will make you try to force trades that don't really work. It'll make you try to see things that aren't really there. It'll make you try to force stuff, and it's often a slow death. Okay, if be patient with waiting for what looks obvious to you. Okay, some days I don't trade at all, and it just is what it is. Okay, but sometimes more is less in those periods of time. Okay, here's the other thing. We might have some people that don't want to do this, that feel like they don't have to do this. I talk to people who are in the professional side of finance. They feel like they don't have to do this. There is no exceptions to this rule. All right. Write your thesis down, whether you're investing or you're trading, write it down. There's no exception to this. Okay. I do it for every single trade I make. Have a plan, always follow the plan. I know sometimes I said I break the plans, very rare cases, and I've been doing this for a very, very long time. When you're new, always follow your plan, even if it turns out to be a bad plan. Because remember, you're not trying to get rich off one trade, trying to get rich off 1,000. And what you're doing is you're being a scientist. You're collecting the data. Follow the plan didn't work, but I followed it. Okay, next time I'm going to adjust this on this plan and see how that plays out. And then every time you're collecting a new data point and you're using that to build up your plans in the future, maneuver it that way. Maneuver over a set of 10 trades, not over one trade. Okay. Because if you start changing your plan in the middle of the trade, 9 times out of 10, you're just being emotional about it. You're making an emotional decision that's likely bad. When we get emotional, our brains just don't work as well. Okay. We start making dumb decisions with money, very easy to be emotional. Okay. So just follow the plan, almost like a robot. It's just what you're going to do. Okay. And that's going to be it for our presentation.